You've probably heard it before. The rich pay less in taxes than everyone else. And if you're a high-income earner paying the highest tax rates year after year, that idea can feel pretty frustrating, maybe even unfair. But here's what most people never stop long enough to realize. The wealthy aren't paying less because they're cheating the system. They're paying less because they understand how the game works. They're using a tax playbook that's written into the tax code, and it's available to you too. Now, if you're a doctor, lawyer, business owner, or other high-income professional, and you're paying the highest tax rates year after year, this video is going to show you exactly how the wealthy legally keep more of what they earn. And no, you don't need to be a billionaire. You don't need insider connections. You don't need to quit your job, and you don't need to do anything shady. You just need to understand the rules of the game. And once you do, taxes stop becoming something that happens to you. Instead, it becomes something you can proactively plan for and intentionally lower, maybe even to zero. And to do that, let's start with why high-income earners feel stuck, while the wealthy seem to have it so easy. Let's dive in. For most high earners, taxes feel like a treadmill you can't step off of. You work harder, you pick extra shifts. Sure, you earn more, but you also lose more to taxes. But the rich, they don't just earn more, they earn differently. They don't just collect income, they build assets that generate income that the tax code treats more favorably. Think about Warren Buffett. He's openly shared that he pays a lower tax rate than his secretary. He's not cheating the system. He just figured out that the income he makes from his investments is taxed at a much lower rate. So he intentionally makes most of his money from his investments, not from a paycheck. Or take Donald Trump. During the presidential debate, when Hillary Clinton accused him of paying zero taxes, he said, "That makes me smart." Now, whether you like him or not, that statement was technically true. He wasn't lying. He was using the tax code the way it was written, using real estate to completely zero out his taxes legally. And that's the key. The tax code doesn't punish investors. It rewards them. So if you're paying ordinary income tax rates on everything you earn, you're leaving thousands or even hundreds of thousands on the table every year. And it's not because you're doing something wrong, it's because you're playing off the wrong playbook. If you earn a salary, the system is designed to take a big chunk. And once you see that distinction clearly, the next question becomes obvious. What exactly are they doing differently? Let's break down the core strategies the wealthy use, and you should start to see how you too can use these strategies to significantly lower your taxes. When people hear tax strategy, they usually imagine something complex or exclusive. The truth is, it isn't. They might sound confusing the first time you hear about them, but if you hear about them enough, you can master it quickly. Let's walk through the core strategies that matter most. Strategy number 1. Bonus depreciation. When you buy real estate, the IRS lets you deduct a portion of the property's value each year as if it's losing value. This is called depreciation. It's the same as a car losing value the minute you drive it off the lot. But here's the magic. With real estate, unlike your car, real estate usually goes up in value over time. And while your property is going up in value, the government allows you to claim the depreciation loss as a tax deduction. On paper, the building is wearing out, but in reality, it's going up in value. And with bonus depreciation, you can take a huge chunk of those depreciation deductions up front, sometimes writing off as much as 30% of your purchase price in the first year. For example, if you buy a $1 million property, that can create as much as a $300,000 tax deduction. That's how investors shelter hundreds of thousands in income without changing their job or income level. But depreciation alone isn't what really changes the equation. The real leverage shows up when those losses can offset your salary. That's why the next strategy is so important. Strategy number 2. Real estate professional status, or REPS. If you or your spouse qualify as a real estate professional, you can use paper losses from depreciation to offset your ordinary income. That means W-2, 1099, partnership income, or business income. It's one of the most powerful tools for high-income households, especially doctors and dual income families, because it can legally bring your taxable income to zero. It's how my wife and I were able to legally shelter 100% of our income for 7 years in a row. And we weren't sheltering 5-figure incomes. We were sheltering multiple 6-figure incomes. But what if you don't qualify for real estate professional status? That's where many people assume the door closes. It doesn't. Strategy number 3, the short-term rental strategy. Short-term rentals, or Airbnbs, have their own carve-out in the tax code. If you materially participate, meaning you're actively involved in managing them, they can be treated as a business, not passive income. That means those same depreciation losses I described earlier can offset your W-2, 1099, or active business income, even if you're not a full-time investor. We've seen students of our courses buy a single short-term rental and shelter multiple 6-figure incomes in the first year. And once investors start building equity, the tax advantages don't stop when they sell, they compound. Strategy number 4, 1031 exchanges. When you sell a property, normally you pay capital gains taxes, but the IRS gives you a way to defer those taxes using a 1031 exchange. You simply roll your profits into another property and your tax bill is postponed. Keep repeating that and you can literally defer taxes for your entire lifetime. You're not avoiding taxes, you're postponing them. That's why wealthy families grow generational wealth through real estate. They don't just make money, they compound it for generations, tax-free. And real estate isn't the only place this shows up. Strategy number 5. Business ownership. Real estate isn't the only play. Owning a business also unlocks a range of tax advantages, from deductions to retirement contributions to control over how your income is classified. Many high-income professionals combine real estate with a business, stacking multiple strategies together. At this point, most people aren't confused by how this works. They're stuck on something else entirely. Here's where most high-income earners get stuck. It's not a lack of intelligence. It's not a lack of income. It's hesitation. It's paralysis. They avoid taking action because they assume they're not cut out for it. They think, I'm not good at finances. I don't have time. This sounds too complicated. But here's the truth. You can be good at finances and you can be a great investor. You just need to learn enough about real estate investing and the tax benefits. And as my wife likes to say, real estate isn't med school hard. It's a whole lot easier to learn and master. The real reason many don't act is mindset. They think it's too hard and they'll get to it someday. But that someday never comes, because most people don't fail due to lack of ability. They fail because of inaction. They fail because they keep postponing things. They assume they'll figure it out later, and that quietly turns into years. So the real question isn't whether this is possible, it's whether learning something new actually has to feel overwhelming. Let me give you a simple example. The other day, my son was struggling with a new math concept. He got frustrated, said it was too hard, and he wanted to quit. I told him something I'll tell you now. Hard isn't a bad thing, it's just a feeling. And that feeling is usually a fear of failure. So I encouraged him to push through the fear and take the first step. Once he started taking steps, one problem at a time, it got easier. It's the key concept covered in the book Atomic Habits. 1% progress each day adds up fast. That's how our student in our real estate course, Zero to Freedom, succeed. We don't throw them into the hardest parts of real estate, like building a full team or putting in offers right away. We start small. They make progress and they gain confidence. And once they buy that first great deal, everything changes. They realize they can do this, and from there, it's just repetition. Which brings us to what this looks like in real life. We had a student, a physician earning over $500,000 a year. For years, his CPA just filed his taxes. There was no strategy, no discussion. When she joined our program, she learned about real estate professional status and cost segregation. We connected her to a real estate CPA, and within months, she bought her first property. That single purchase allowed her to shelter nearly half of her income. The next year, she bought again and sheltered even more. She didn't change her job, she didn't work harder, she just learned the tax playbook and started using it. That's the difference between paying 40% in taxes and paying close to zero. And that leads to the most important question of all. Where do you start? If you want to start using the same playbook, here's what I do. Start by finding out how much you're paying in taxes. You can look at your tax return, or better yet, ask your CPA to look it up. Next, once you have that number, make a decision about how much you're going to lower it. Are you going to lower it to zero like we did? Or maybe you'll start out by aiming to lower your taxes by 50%. Once you have your target, the next step is talk to the right CPA. Find one who specializes in real estate investing for high-income professionals. Ask them about real estate professional status, the short-term rental tax loophole, bonus depreciation, and 1031 exchanges. From there, educate yourself. Learn the fundamentals of real estate investing before diving in. You don't need to know everything. You just need to know enough to recognize opportunities. Take action. Buy that first deal. Even a small property can change your tax picture dramatically. The rich aren't smarter than you. They're just strategic. They use the rules, the same ones available to you, to their advantage. You've worked hard to earn your income. Now it's time to work smart to keep it. But the truth is, the tax playbook isn't secret. It's just underutilized. So if you're ready to stop overpaying the IRS and start playing the same game as the wealthy, book a free strategy call with our team so you can copy the playbook, take action, and get started. Thanks for watching. We'll see you in the next video.